Thank you very much. It's a pleasure for me to be with you in Bangkok today. Um, and, I think it's probably 7 years since I was here last, and there's been a lot of change and a lot of growth. It's very good to see.
Yeah.
Um, Last year at this time, historically, I've always made a trip to Asia for a few weeks and a trip to the Middle East in the fall. And so last year at this time, I resumed my travel along with my partner, Bruce Karsh, my Oak Tree co founder, co chairman. And as we spoke to clients, we didn't rehearse what we were going to say, but, we found ourselves talking about the sea change and the what was going on and the importance, the significance, and we agreed that it was very significant. This is, you know, I've been working now 54 years, and the first two that I saw, I was too young to appreciate. I didn't have the perspective. So this is really the first sea change that I'm uh, on top of, aware of, responding to, and taking action. And I think it's very significant. Um, you know, as I said in the Sea Change memo from December, in 1980, I had a loan outstanding from a bank, and I got a slip of paper in the mail, and it says your interest rate is now 22 and a quarter. And 40 years later, in 2020, I was able to borrow at 2 and a quarter. So that's a decline of 2,000 basis points over 40 years. I believe that it is the most significant event in the financial world in the last half century. But most people don't appreciate it because it was gradual and took a long time. But, declining interest rates make business stronger, make the value of assets rise because asset value is the discounted present value of the future cash flows. And if you lower the discount rate, you raise the value. Reduces the cost of capital. Um, Makes it harder to default or go bankrupt. Makes it easier to raise money for financing. So in all of these ways, this was very, very positive for asset owners and for borrowers. And of course, if you buy assets with borrowed money, you've got a double benefit, and that is, many levered strategies were invented in the last 40 years. It's not a coincidence that probably more than 99% of all the buyouts that have ever been done have taken place since 1980. And so I think the world of the next 10 years is going to be significantly different from the world of the last 40 years. And I think if that's true, I think we have to do something about it.
Thank you very much. And I think you're far too modest. You said you didn't know very much, but you set up Oak Tree in 1995. I thought that was a huge accomplishment, sir, and Oak Tree has grown so much. But I think the other point that you made is how you manage the risk. Please share with us your experience on that count for the past, and also as we move forward into the future, into this new sea change, risk management.
Well, as you say, Oak Tree was founded in 1995 by myself and four managing directors who reported to me at TCW. And since we had been working together on average for 9 years already at that time, we knew what we would do. We didn't have to figure out how we would operate or what our philosophy would be. And we wrote down an investment philosophy, very simple, but six points. The most important one is number one, of course, risk control. And, I got into money management in 1978 when Citibank asked me to organize a high yield bond fund and department at Citi. And that 1978 was really the beginning of the high yield bond world. So it was great to be in at the beginning. I think that our fund was the first one from a mainstream financial institution. And throughout my career, I've been doing things that were scary on their face. Now, in my opinion, that's how you get a bargain, is you do something that other people find unappealing. Nobody else is lined up to buy it. You may get a bargain. But the point is that we have done things, high yield bonds in 78, distressed debt in 88, emerging market equities in 98.
Yes.
And you do much better when you do the things that other people don't want to do. If everybody else wants to do it the same time you want to do it, then there'll be all these people lined up to buy it. There'll be all kinds of optimism incorporated in the price. You won't get a bargain. But if you're going to do the things we do, scary on their face, we have to have the risk under control. We have to be able to assure the clients, that we'll be taking a cautious approach in what they might consider a risky area. We know that a risky approach in a risky area could be quite dangerous. But by taking a cautious approach and thinking about not so much what can go right, but what can go wrong, that has brought us great success over the years. And I don't believe in forecasts. I don't make predictions for the economy or the currencies, commodity prices, interest rates, etc. And I think it's very hard to do that consistently right. But that introduces a complication, because investing consists of positioning your capital to be prepared for future events. So how can you prepare for future events if you can't predict them? I think the answer lies in a memo that I wrote to clients about 25 years ago, and it was 20, and it said, the title was "You Can't Predict, You Can Prepare." Now that sounds like a contradiction, but it's really not, because you don't know what's going to happen. And I believe that we never know what's going to happen. Sometimes we have a sense, but especially we never know when. And the linkages and the lags and the leads time-wise can be very frustrating. But you have a sense for what's most likely to happen, for the other things that probably could happen, and then finally the things that are unlikely. And I think the answer is that you have to prepare for a variety of scenarios that you think are likely. The key concept is something called margin of safety, or margin for error, which is to say that even if the things you hope will happen don't happen, you should be okay. That's really the key criterion. Some people, they say, I think this is going to happen. And they put all their money, like in a casino. They pick one number. They put all their money on that one number. And they say, if it hits, I'm going to get rich. But rarely does it hit. And they're surprised that they end up frustrated. If you cover a variety of possibilities, spread your bets, allow for error, I think you have a much higher probability of having success in the long run.
And you talked about the other 5 principles. If you may quickly go through those.
So number 1, risk control. Our motto is, if we avoid the losers, the winners take care of themselves. So, we don't go out hunting for elephants. We just go out, we want to have a large number of good investments. In fact, The Financial Times has a column on Saturdays called Lunch with the FT. And they took me to lunch in December at my favorite Italian restaurant in New York. And I said to the reporter, I said, eating in this restaurant is like investing at Oaktree. Always good, sometimes great, never terrible. And this is really one way for me to describe my goals. It would be great to say we're always going to be terrific, but it's not true. Nobody can produce that. But if you can just do, you don't even have to be good all the time. You're good almost all the time, great some of the time, but never terrible. And if you do that for a few decades, you'll have one of the greatest records in history. So risk control, consistency, not top decile, bottom decile, top decile, bottom decile, but around the middle all the time. And then in our experience, we pop up to the top in the bad times. When things go wrong, because of our emphasis on risk control, we're better prepared than most. So I think that's extremely important. Number three, we're only active in what are called less efficient markets. An efficient market is a market where everybody has all the information. Everybody knows how to deal with the information. And as a result of the efforts of thousands or millions of investors to value something, the price converges with the intrinsic value. So that this one is better, the price is higher. This one is worse, the price is lower, but the price is about right for the value. Well, clearly, if price is always equal to value, then there are no bargains. So even a great stock picker can't add much if there are no bargains to be found. That's an efficient market. And there's something called the efficient market hypothesis, which I was fortunate to learn at University of Chicago in graduate school in the middle 60s. But there are less efficient markets, and we're sitting in one of them. The emerging markets are less efficient. The information is not quite as broadly distributed or as well understood, and there aren't as many people looking and trying. So in a market like this, high yield bonds, distressed debt, private credit, we can have divergences of price from value, and it's possible to find bargains to buy, find overpriced assets to avoid. So there is scope for contribution from active management. Number four, high degree of specialization. We don't try to do everything. We do a few things. We try to do them well. Our people are not generalists, they're specialists, so that each of our strategies has its own research capability, and it's not pulled in multiple directions. Number five, I already mentioned it, our investment decisions are not driven by macro forecasts. We are what's called bottom-up value investors. We don't say what's going to happen in the economy, what industries will do best, what's going to happen to currencies, which are the companies we should get into. Rather, we go from the bottom. We just look for companies that have merit, where the securities are not fully reflective of that merit. Bottom up. Number six, we're not market timers. We don't get in, get out, get in, get out. Very hard to do that on a regular basis with success. And I'll tell you one thing that we never do, since we're not market timers. We never say, it's cheap today, but it'll be cheaper in 6 months, so I'm going to wait. Because you could be wrong. And you often are. So if it's cheap today, we buy it. If it gets cheaper, we buy more. And then, of course, we only need for our thesis to be correct.
Thank you for that. I think when you talk about less efficient markets and divergence of price from value, I think that that's easy to say. It seems to me from my experience, but to assemble a team, as you say in number four, of specialized people, um, how do you actually go about that? Just to ask you, because you have a very consistent record of success.
Well, we have a great team. The senior members of the team have been with us a long time. For example, we have Frank Carroll with us today. Frank is head of our emerging market equities area. Frank is making some of these visits with me. And Frank is with us 25 years this year. And Frank's kind of average. We have people who are there a little shorter, but we have people who are there longer. And then we have, I think we have an effective philosophy. I think our philosophy, we wrote it down 28 years ago. We haven't changed a word. It still works, and I think that intellectually and practically it holds together. And we have a very high emphasis on maintaining the culture and passing it on. So I like to believe that we can continue to perform well over time.
Thank you. Let me switch gears and come back to your other main thesis, which I found very profound. You say in your later memo more precisely that you think bonds starting to look very, very attractive versus stocks. Please elaborate on that. I
Well,
thought that was very important.
this is really the sea change.
Yes.
Anybody who came into this business since 1980, and I assume that covers most of you, has only seen declining interests or ultra low interests in all that time. And what happens is that people, when they live through something for a while, they tend to believe that this is normal and this is the way it's always going to be. And of course, 40 years, that's 2 generations. So we have had this declining and low interest rate regime for a long time. But and part of what happened with that is that bonds, fixed income, credit, debt, these are all different ways to say the same thing, became very unattractive.
Yes.
And, in 2009, the Fed cut the Fed funds rate to 0 to battle the global financial crisis. They were successful. They brought the U.S. economy and the U.S. markets back to life. For some reason, they stayed with 0 rates for 7 years. We didn't have an emergency for 7 years, but they stayed there, which I don't understand. And then they tried to raise rates, and they chickened out. In early 19, they started cutting them again. And then, of course, we had the pandemic, and they cut them back to 0 again to pull off another rescue. As a result, I focus in the memo. I hope you'll all read it. And by the way, all of my memos are available at oaktreecapital.com under the heading of Insights. And you can read 33 years of memos, and you can subscribe to them and be notified whenever one comes out. But the point is that and the memo talks primarily about this period of 2009, when the Fed took the Fed funds rate to 0, through 21, when the Fed gave up on its hope that inflation would just go away. And in that 13-year period, the Fed funds rate averaged 0.5%, which is a tiny interest rate, very unusual. And I gave a speech from 2012 through 2020, and the title was "Investing in a Low Return World." The bondholder or the debt investor, that's where we were. We were in a low return world, and it was quite unattractive. Even just, let's say, 20 months ago, high yield bonds, which is our original product, how I got into being a portfolio manager, they yielded 4%. They were not high yield bonds, they were medium yield bonds. But they were much higher before, and they're much higher now. And today, high yield bonds yield about 9.5. That's very different from 4. 4, most of my clients did not find very useful. 9.5, very useful. In fact, the S&P 500 stock index has returned about 10.2% a year for the last century, on average, with stronger periods and weaker periods, of course. And that 100-year compounding at 10.2 was enough to turn $1 into about 14,000. So that's a pretty good rate of return, 10.2 on equities. Today, we can get equity returns from debt. And we're very excited about the ability to do that. And we had to sit quietly for a long time and keep our organization together and give the young people something to do, even though the times were not propitious for our activity. But now they are. And so the real sea change is that today you can get equity returns from debt. And the absolute returns are quite generous. You don't have to use leverage today to make a good return. So an unlevered portfolio of debt will give you a return in line with a little more or a little less than equities, with the risks under control, because debt investing is considerably more dependable than equity investing. And this is a big change that I think most people have not fully responded to.
I have to follow up on that one. You said that distressed debt is a risk that's under control. I mean, see, you said yourself, we are relatively young, and we've always thinking of equity, and we think, oh, distressed debt, that's scary.
Yes.
Yeah, that's very scary. But you start off with distressed debt, so please impart your wisdom onto why we shouldn't be scared of distressed debt versus equity. I'm not saying that they are not risky, but please elaborate, because for us, we the sense is still we don't want to touch dangerous bonds. So.
Well, as I mentioned earlier, in 1987, I was joined by my partner, Bruce Karsh, at TCW. He came to me and he had the idea to invest in a fund for distressed debt, form that fund. And, at that point, I'd been investing in high yield bonds for 10 years. Every once in a while, you buy a bond at 100 cents on the dollar. It goes bankrupt, it falls to 10. You go on the creditors committee, you work through the bankruptcy, you try to maximize during the restructuring, and you get 30. So very simple. Karsh's idea was, why don't we start a fund to do the 10 to 30 part, not the 100 to 10 part. And so we did in 1988. Again, I think that was the first distressed debt fund from a mainstream financial institution. And it's been very successful. Our mantra is good company, bad balance sheet. So at times of weakness, we can find good companies, good products, good management, just too much debt. Maybe they went through a buyout, or maybe they borrowed too much to grow on their own. And rather than have good times in which they could grow, they ran into bad times in which it was hard to survive, especially with a heavy debt load. But the point is that a good company with a bad balance sheet is easily fixed. all you have to do is go bankrupt. And under bankruptcy, under our laws, you get to discharge your debts, reject onerous contracts, and the company is restored to viability. That's much easier to fix than a bad company. So that's what we do. Good company, bad balance sheet, not bad company. We're not turnaround artists. So that's one of the ways in which we reduce the debt. Secondly, every capital structure, every company capital structure has a variety of elements. Equity, maybe preferred stock, junior debt, senior debt, mortgage debt. And almost all we do is at the senior debt, senior and secured. And, you know, the lower you invest in the capital structure, the more you make when you're successful.
Yes.
But you're not as successful as often. The higher you are in the capital structure, your return in the case of success might be a little less, but you have much fewer failures. And if we go back to lesson number 1, avoidance of losers, that's a good way to do it. So the point I want to make to you is that here we are, 35 years later. We have managed about 60 billion in our distressed debt funds over the years. And you can see that this is not, invest and pray. This is an activity that can be done profitably over and over and over again, more than 90% of the time.
But to be fair, I mean, we've been investing in equity. And so I think a lot of people don't have that skill set, if you will, that you have. And I think it was important that you mentioned that, in fact, if you're an equity investor, you're actually at the highest risk on the balance sheet. And that's something I don't think we've I think appreciate.
Well, think about it. Where do returns come from? If you are a debt investor or a lender or a bondholder, you basically have a contract with the company, which is the borrower. And you say to the borrower, I'll lend you $10 million. You pay me interest every 6 months. At the end of 7 years, you pay me my $10 million back. So my return is contractual. We have an agreement. The only way it fails is if you don't keep your promise to me. And in that case, I get your company through the bankruptcy process. So the borrower has a great deal of incentive to stick to the contract and pay. And so the cash flows are predictable and generally dependable. That's as opposed to equities. In equities, there's no contract.
Yes, sir.
And there was a guy named Ben Graham, who was Warren Buffett's teacher at Columbia. Ben wrote a book called The Intelligent Investor. And he talked about somebody called Mr. Market. And Mr. Market wakes up every day, and we find out what mood he's in. Sometimes Mr. Market's in a good mood. Sometimes it's in a bad mood. And our performance as equity investors is dependent on Mr. Market's mood. And so the equity investor does not have a contractual return. He just gets his share of whatever's left at the end. You buy raw materials and labor. You make a product. You sell it. You get a profit margin from that. You pay off your taxes and your interest on your debt, and we see what's left. And as equity investor, I have a right to my share, but maybe I don't get my share because the company doesn't declare a dividend.
That's right.
So you can see how different it is from debt investing. And I spent my first 10 years in this business as in equity research, like yourself.
Oh, 10 years.
Yes, 10 years. And from 75 to 78, I was Citi's director of research, like you. And when I switched to bond investing, I must say I was flabbergasted at the difference. And most people don't understand that it's not a little different. It's enormously different. And you see that in the fact that the values are much more resilient, and the negative surprises are much less negative.
Thank you. I should have met you 25 years ago. I've been head of research for 25 years. I should have made a career change. But let me move on to another point. I think if looking ahead, we do indeed have this sea change. Where are the opportunities, do you think, in this world? I mean, there's emerging markets. There's also probably opportunities in US and Europe as well. What is your view on the opportunities out there?
Sure. I see there's a board here. I like to draw pictures.
Please do.
So I'm going to draw a picture. I hope everybody can see. We have in our business what we call the capital market line. And it looks like this. Here is the return on your portfolio. Here is the risk of the portfolio. And here is the outcome. And basically what it shows is that at zero risk, we collect something called the risk-free rate, which is usually the rate on T-bills. And then from there, as we increase the risk, the return also increases. And I mentioned going to University of Chicago 65 years ago, 55. This is what a good part of what I learned there. Can you see this? Okay. So before I go on, I want to stress one thing, because this is like dangerous, this graph. The reason it's dangerous is because this is presented as a linear relationship. And so, in my opinion, it gives the wrong idea. Because most people who are familiar with this, if you say, well, what does it mean? They say, riskier assets have higher returns. And if you want to make more money, you just take more risk. Think about it. Doesn't make any sense. If risky assets can be counted on for high returns, then by definition, they're not risky. So that can't be right. Something's wrong with that. And the answer is that the returns on the riskier assets should be expected to be higher. If they're not expected to be higher, nobody will make a riskier investment. You only do it because you have the incentive of a higher possible return. But the return does not have to come through. It does not have to be delivered. And that's where the risk lies. So if you go to Oak Tree Capital and you look at a memo called Risk Revisited Again in 2016, what I did is I took some little bell-shaped curves and I stuck them on the line. Now, as you move from left to right, increasing the risk, the expected return increases. We're still working with the same underlying line in terms of the relationship. But now, the range of possible outcomes becomes wider, and the bad outcomes become worse. That's risk. That first line gave a misleading picture. This is risk. High expected return, wider range of possible outcomes, and some outcomes which are inferior. So this is what we do for a living. We make these decisions for a living. We happen to operate all along here, but mostly in the more aggressive parts. But you know, if you have an activity, as we discussed, distressed debt investing sounds scary, but if you have superior skill, you can get the scary part under control and have frequent success. So you asked what's offered today, and we have. I mean, you can invest all along this spectrum.
I think that that's very enlightening, and I like that diagram a lot. I think for us, people who've always been thinking about equity, I think we have to go and rethink how we approach investment. I think I would like to ask you just one final question, and I'd like to open it up for the audience. I think many of whom will have questions for you. I go back to your closing thoughts. Anything else you want to tell us? And of course, your books, which have been translated in Thai. So give us a few sentences on your books. This is the most important thing, and mastering the market cycle.
Thank you for asking. I never try to make investing sound easy. It's not easy. A friend of mine wrote a book about investing. He had a very attractive title: Simple but Not Easy. The concepts of investing are simple. Well, all you have to do is go out and find the ones that will perform better than the rest. Simple, but not easy to do in practice. And, you know, as I said, I don't try to make investing sound easy. I show it for what it is. But if you are conscientious and hardworking, and if you have a workable philosophy, and if you understand your own limitations and your biases, and if you have control of your emotions, I think you can do a good job on balance over time. And that's all any of us should hope for. As I said earlier, nobody can produce returns that are always great. In fact, if you think about it, most people and most strategies have a bias. Either they have an aggressive bias or a defensive bias, and the aggressor does really well in good markets,
Yes,
but loses quite a bit in bad markets. The defensive investor does pretty well in the bad markets, but doesn't participate much in the good markets. It's very unlikely that anybody can do both for you, outperform in the good times and outperform in the bad times. Now, our bias is toward outperforming in the bad times. And everybody, you know, the mantra for investors is beat the market, beat the market. I want to beat the market. I want to beat the market. Why? You know, I've never had anybody tell me cogently why it's important to beat the market when the market does well. When the market does well, everybody makes a lot of money. Why isn't that good enough? Why do you have to outperform a market that's performing well? In order to outperform, generally speaking, you have to have an above average helping of risk and correlation and volatility. And that's fine in the good markets when you make more. But what happens if it turns out that we have a bad market instead and you lose more? That's not much fun. I think the time when it's important to outperform is in the bad markets. Everybody else is losing a lot. It feels wonderful to only lose a little. But if you can combine bad years in which you lose much less than the other person with good years in which maybe you do the same, obviously your long-term result will be a higher return, less volatility, and a higher comfort level throughout. And I think that the comfort level cannot be overstated, because the cardinal sin of investing is not buying something that doesn't work out. The cardinal sin of investing is getting out at the bottom. Everything that happens conspires us to make us do the wrong thing. when the economy is doing well and the companies are reporting good results and the prices are rising every day, people get excited. They become optimistic and they buy and buy more as the prices go higher. But then if something goes wrong and the economy and the companies start to do a little less well and the security prices are falling, people get depressed and they start to sell. And the lower the price goes, the more they sell. Well, my mother told me, buy low, sell high. But our emotion tries to make us buy high and sell low. This is the worst possible thing. And so the most important single thing is to invest diligently, patiently, over a long period of time. Allow compounding to work and don't get out at the bottom. If you can be what we call a contrarian and do the opposite, if you can get out at the top and invest aggressively at the bottom, that's the best of all worlds, but it's not easy. So if you merely can avoid getting out at the bottom, then you're ahead of most people. And, we have been able to facilitate that for our clients.
Well, I agree with you. My experience has been that it's very, very difficult to outperform at the bottom. It's been so difficult. But I think I go back to the audience now, and I think we have a question out here for you. If you were to assess the temperature today, would you feel that the investment community is too complacent given the changing environment?
Well, while you're thinking of your answers, what he's referring to is that my attempts to figure out where the market is in its movements, I call taking the temperature of the market. Is it too hot? People like it too much. Everybody's too optimistic, which means prices are too high. Or is it too cold and people hate it too much, which means that usually the prices are too low and you should be buying. Which is it? And I put out a memo 3-4 months ago called Taking the Temperature. I described the 5 calls on the market that I've made since 2000, all basically correct, sometimes a little too early, but successful. The key, and I was working on my second book, which is called Mastering the Market Cycle, and talking to my son, who is my confidant and my partner. And I said to him, Andrew, I think my market calls have been about right. And he said something brilliant. He said, yeah, Dad, that's because you did it 5 times in 50 years. 5 times in my career, I have found the market down here where it was clearly a buy, or up here where it was clearly a sale. And so I was able to go 5 for 5 on those forecasts. But instead of 5 times, what if I had tried to do it 50 times, or 500 times, or 5,000 times? My batting average would have come down. And if I had tried to, I've worked 50 years, 200 working days a year, that's 10,000 days. If I tried to do a judgment every day, I'll bet where I would be? 50-50, coin toss. So I think, you have to just try to make those pronouncements only at extreme moments. We are not at an extreme moment today. The market is the markets in general. I'm not talking about any specific market, but the markets in general are in what I call the zone of reasonableness. They're not so high that they're an obvious sale. They're not so low that they're an obvious buy. The U.S. stock market's a little high.
Yes.
So in choosing your posture, you might have a little more defense than usual, a little less aggressiveness than usual. But in general, I think that the market is in that middle ground where there's nothing that clever to say. And so we try to outperform not by market timing, as I said, but through superior bottom-up asset selection.
Let me follow up on that a little bit because I think a lot of people like myself, we have been used to zero interest rate for over a decade, both long end and short end. And so we're a little bit afraid that now that interest rates are in the 4-5% range, is this something to worry about that something could break? Because we have been, so comforted by rock bottom interest rate for a long time. I think that's where the sense of the question was coming from.
Well, first of all, one thing I want to tell the audience is this is not high interest rates. We had ultra low interest rates for so long that it felt like normal. So that 5 seems high by comparison, but it is not. I think today's interest rates are quite normal.
Okay.
And if you look at a chart of the Fed funds rate over the last 70, 80 years, I think if you just eyeball it, I think you'll see that 5 is kind of normal, and today we're at 5.25, 5.5. So we're not at high interest rates. I also don't think that the interest rates are high enough to, in themselves, cause a problem. They're not high enough to bring on a large recession. I don't see excesses in the markets. What people should worry about is that the aggressive buyers during that 13-year period, and especially the people who bought assets using borrowed money to amplify their returns, these people may be in for some trouble because you put on a lot of leverage when leverage is cheap, not cheap anymore, and these companies were created with capital structures which did not anticipate that interest rates would be 5% higher, so there are a lot of companies that have too much debt because conditions in the capital markets have changed. They're not going to have an easy time refinancing that debt when it comes due. And so we'll probably have more defaults and bankruptcies. But of course, that's how the opportunities funds make their money. The funds with the highest returns are generally the funds where we were able to actually experience bankruptcies and get control of the companies or get the value of the assets at a low ebb and then enjoy a recovery. So I think that this is going to be a harsher environment than people have been used to.
Yes.
Since 2009, when we were still suffering the effects of the global financial crisis. But I'm not worried about it. The markets I worry about are the ones where everybody loves everything, and so the prices are so high that there are no bargains. That's what keeps me up at night.
I don't know if you care to answer this other question here. Do you think the Israeli-Hamas conflict matters for us in terms of our investing outlook?
Number one, there's always something going on. Now, it may not be as terrible as the Israel-Hamas situation, but there are always things to worry about. And we always look at the past and we say, "Oh my God, if only we could go back 30 years. It was so great then, and now it's so difficult today." But of course, we don't necessarily remember things clearly.
That's right.
And a football announcer in America once said on Monday Night Football, "They don't make them anymore the way they used to, but then again, they never did." Our memories are too fond of the past. So I always assume that we'll muddle through. We'll find a solution to the Hamas-Israel crisis. And the other thing is that, what happens in the investment world is that if somebody has a reputation for being a good investor and has made some money, then people start to treat him like he's a genius on all subjects, and that's certainly not the case. So I think number one, I'm no expert on Israel Hamas. Number two, I don't know if there are any experts on Israel Hamas. You know,
Sure.
this is a unique experience that we've never been through before. So where would expertise come from? And I put out a memo just a year ago called "The Illusion of Knowledge," and I talked about going to. There's a series of lunches in the Hamptons in New York every summer, run for people in the investment business. And I went to one in the summer of 22, and that's why I wrote this memo. But you know, the host says, Howard, when will we get out of Ukraine and how? You know, or what's going to happen? You know, with the dollar versus the euro, and my reaction is, why are you asking me? I don't know. I don't know anything about these things. You know, what's going to happen in Ukraine? I don't know a damn thing that any intelligent person who read today's newspaper doesn't know. But there is this tendency to associate investment profits with intelligence. That's sometimes wrong. But you know, so as I say, at Oaktree, our investment decisions are not driven by macro forecasts. We're not going to change our investment process just because there's a conflict between Israel and Hamas. And these are not the things that matter in the long run. What matter in the long run is how do the companies you invest in do? Israel Hamas will influence security prices. Well, interestingly, they haven't had any influence yet. They may have an influence in the future, but it's not going to be long lasting. What we have to do is make fundamental decisions about which companies are good, which stocks, which companies will grow, and for us, which companies will honor their promise and pay debt and interest and principal as promised. These are the important things.
Thank you. We have about only 4 minutes left, and again, this last question, I guess, goes back to the point where we ask again for your wisdom in terms of how do we, as investors, what lessons should we take from you, from your 54 years of investment, and that we could use so that we can navigate the next 10 years successfully. Again, final thoughts on investment.
Well, you know, Buffett always goes back to the analogy of baseball. And the investor is kind of like a hitter in baseball. He's up at the plate, the pitcher's throwing the ball, and the batter has the choice to swing or to not swing. And unlike baseball, the investor can't be called out if he lets a few pitches go. So you can stand there and you can wait until you have a great pitch. And that's what we try to do. We don't try to invest a lot of money in every market. We try to vary our approach as the market gives us more or gives us less. Today, the bottom line is that the market is, because of the sea change,
Yes.
is offering us, meaning you, an unusual opportunity to make a lot of money through credit investing with moderate risk. And I would encourage all of you to take it. That's the message I'd like to leave behind.